Welcome to Interactive Investor's Super 60 Fund Finder.
An active fund is managed by a professional investor. The investor invests in a certain number of investments that they believe offer the best growth or income prospects. A passive fund, on the other hand, simply tracks the up and down movements of a stock market index, such as the FTSE All-Share. Passive funds are called either index funds, tracker funds, or structured as exchange-traded funds, ETFs. Among the advantages of active funds is that your money is spread across a large number of different investments. This gives you diversification, which helps to reduce risk. There's also the potential that the fund manager will outperform the wider market. But with active funds, bear in mind that the fund manager outperforming is not guaranteed. They may not outperform and you will still be charged an annual management fee. The main advantages with passive funds is that they are low cost and they offer investors an easy route to accessing major markets. They also offer investors instant diversification as your money is being spread across a large number of different investments. The main disadvantage with a passive fund is that by definition you will not outperform the wider market that passive fund is tracking. Interactive Investor's Super 60 list has both active and passive options for a variety of different markets and asset classes. For passive global exposure, we have the iShares Core MSCI World ETF. This ETF tracks the up and down fortunes of around 1,600 global shares. In terms of actively managed options, three global funds in the Super 60 are FUNDSMITH Equity, F&C Investment Trust and Scottish Mortgage Investment Trust.
The big question.
A common approach to deciding when to allocate between active or passive investments is based on the efficiencies of an underlying market. Developed markets, most notably the US, are very efficient, which make it more difficult for active managers to outperform. As such, for these areas, passive investments such as ETFs and index funds can be utilized to provide low-cost exposure. Areas which are less efficient, on the other hand, such as emerging markets or smaller companies' equities, as an example, can be devoted to active strategies. Investors can employ both active and passive approaches in a core satellite strategy. This is when the core of your portfolio is invested in a low-cost passive investments and the rest is then allocated in satellite, actively managed investments, which typically have the potential to boost returns and lower overall portfolio risk.